I'd have to go to you and say, Natasha, I want to buy a car. How much are you going to charge me? Luis, I want to buy a car. How much are you going to, do you have $20,000 to loan me? Oh, you don't? Okay. Carlicia, do you have $20,000? Yes. Are you willing to loan them to me? Yes. How much are you going to charge me? And so you get to a point where by creating this central environment, I get all the information. Everybody's rates and terms is widely available, right? How are the funds going to be allocated? Well, in the most efficient fashion, based upon the pricing discovery, right? Right? And at the lowest cost. Because if we're all competing, we're all going to be efficient, hopefully. Okay? So again, very conceptual, very sort of theoretical, but you can understand that by having these central markets, because the information is available, right? We're going to get the most efficient, low cost, and perfectly allocated distribution of goods or services, or in this case, of funds in the marketplace.
What's number 3?
Informational. Okay, so when we talk about informational, we'll spend a lot more time on this as the term goes on. Ultimately, information talks to something called market efficiency, okay? And market efficiency, more broadly, talks to, and again, this goes, this was a guy named Eugene Fama who came up with this theory. He talked about forms of market efficiency, and he talked about weak, semi-strong, or strong form of market efficiency. And what that talks to is market efficiency basically saying is that all information is widely, freely, known and distributed and priced into all financial instruments in the marketplace. Case in point, CenturyLink's up 17% and it's nowhere in the wire, but it's already out there, okay? All information is freely, again, that's a theory, the market efficiency theory, talking to information, okay? It says all information is out there and already priced into all of the securities. That would be a strong form of market efficiency. Does that always exist? And what it also implies is that there are no arbitrage opportunities. What is arbitrage? Basically when you can make some money, you can make some money on a spread. Why? Because you know something. But in theory, in a strong market, you should invest in Vanguard funds because you can never do better than the market because all the information is already out there. You can't beat the market because you don't know more than the market. It's already out there and priced. And listen, whether you buy into it or not, these are theories that help us understand what's happening. Okay? For years, I was always intrigued when you watch these people on TV and read articles about the markets. People talk, always spoke in a way as if the markets knew what was going to happen. Why did interest rates go up 10% before the GDP was announced? Because people knew or had the hunch or the expectation that the economy was strong. And because the economy is strong, presumably the Fed's going to raise interest rates. Okay? And so there's a theory out there, right? This theory that in a strong, right, strong form of market efficiency, all the information's already out there.
So you wouldn't, in a strong market, in that theory, you wouldn't have, for example, Warren Buffett with Berkshire Hathaway?
Yeah, I would say Warren Buffett is more a guy that could live in this because Berkshire Hathaway is almost like an index fund in a way. They just buy big, strong companies that are very diversified. What I would tell you, you wouldn't have a lot of these private equity guys, that a William Ackman that picks one company and says, I think there's a lot of value here.
Gotcha.
You wouldn't have a Jim Chanos that's a short guy saying, hey, that company's bad, but the market hasn't figured it out yet, and I'm going to bet against it. Okay? Now, so let me take the other. The other form is, let's go to the other extreme. Weak form means basically saying, listen, information is not widely available. There's all kinds of arbitrage opportunities. And I'm trying to be offensive in any way, okay? And I don't know if we have anybody that of that action. But for example, take the Indian stock market, New Delhi, right? And compare it to the London Stock Exchange, just to say something, Big regulatory environment, big public reporting to consumers, very strong in historical accounting standards that are published. The one company's known for falsifying financial information, weak or lack of understandable financial standards, no public reporting, thinly traded stocks, large accumulations of stock holdings, right? And I use that one. Most emerging markets, okay? Most emerging markets, stock markets. And so what happens is you neither have one totally here nor one totally here, okay? In a real world, we're probably in a semi-strong environment. And there are arbitrage opportunities out there, right? Insider trading, information that's not widely distributed. We have laws against insider trading. Okay, so these are just theories. But ultimately talk about how information affects pricing and whether it's built in or not. And in a weak environment, and unfortunately in most emerging markets, because you don't have the regulation, maybe you don't have the business practices, maybe you don't have the liquidity, you basically wind up with a weaker form of market efficiency. In more sophisticated, developed, regulated markets, you tend to have a stronger form of market efficiency.
Quick question, pricing there, you said pricing what?
Efficiency.
Efficiency.
But other people refer to price discovery, okay?
Okay.
And so, listen, that's a process. It's also very, very critical.
And I had another question.
Yeah, but before, let me talk, because this is an important concept in real estate in particular, to be honest with you. Price discovery is critical, and that's, just think again, take away the money hat for a second. The former student's developing something, wants to develop something. His family bought a piece of land, and so I put him in touch with 3 or 4 people, and so one of the guys I put him in touch with, actually I called a guy, he's looking for a venture partner, and the guy called me back and he said, look, I don't think the market rents he's using are right, and I don't think his construction costs are right. And so I called this dude and I go, listen, these guys aren't interested. I don't know if this is true or not. I'm not up to date, but this guy's telling you rents are not where you're thinking, and you're light on your construction costs. No, but listen, don't yell at me. This is all an information or a price discovery process. He goes, oh, no, but my rents are $270. I go, this guy's saying it's $240. No, but they're $270. I go, have you called every property in? No, but there's one. Have you called all the properties? No. I said, you need to do that. Because I don't know if 240 is right, but you're telling me it's 170 because you know of one property 2 miles away. But you got a whole competitive set around you. Price discovery is one of the most important things that we can do in marketing. I say marketing, it can be in purchasing also, right? How do we know if we're buying at the lowest cost? How do we know if we're going to sell? And so then I brought him another guy. So I had lunch with them. So this guy tells them, you're high on your construction costs, but your rents are really high. I'm sorry, your rents are really, your rents are really high. So I called them up afterwards and said, you've got 2 guys now that are in the market that are telling you your rents are high. I'm not telling you rents are high or low, but guess what? If there's 2 guys that are in the market that are telling you something, you better raise your antenna. And that's price discovery, right? You want to buy a Honda, what do? You go to Largo Honda, you go to Esserman Honda, you go to whatever, Pachico Leon Honda, whatever, okay? You go wherever.
Auto Trader.
Okay, Auto Trader, price discovery.
CarMax.
Price discovery. okay? That's a critical component, right? That's a critical component and macro benefit of the whole financial intermediation or market intermediation process. What was your other question?
Why is insider trading wrong?
I mean, because you
Oh, no, hold on, listen to me. Listen to me. If the whole thing, how we make money in that semi-weak market is because there is information that is not readily available to everyone, and you discover that, just like you can discover pricing information or something else. So if you come across, and I'm in an elevator ride, talking to my friend here, and he tells me, hey, I think that there's gonna be this and that and this movement, I think this could be a good opportunity.
That's speculation, though.
And I do.
Facts. Hey, there's gonna be a release tomorrow that this is gonna happen, and then you dump all your stock because you know that the news that isn't public, that's supposed to be public, and then you base your decision based off that pre-knowledge. But what you just said is like speculation, like, hey, I have a feeling that this might happen because of this.
So and there's 2 or 3 answers to this. And some of it you have to accept. It's kind of like faith. You know, faith is accepting things that you can't see, right? You know.
Okay.
Number one, it's wrong because it's against the law.
Well, yeah, but I'm
No,
questioning the law.
no, it's wrong because it's against the law. So you gotta stop there. You see, you gotta okay, so that's number one. Let's be pragmatic because it's against the law. And it'll be 2 years now in January ago, I was a witness in a insider trading case in Chicago. And, well, the guy got off, but he was guilty as, as could be. But I would probably venture to say, other than the law, it's probably wrong from a moral perspective. It's because you are acting with information that that's privileged, and you're basically, I mean, we're gonna call this front running. At the end of the day, you are going to make a gain or avoid a loss at someone else's expense.
If I know that there's gonna be
At someone
a new
else's
street,
expense.
if the county's gonna build a new road going through some farmland.
No,
and I go out and
but
buy-
that's not insider trading.
Public knowledge.
That's insider
He doesn't
trading.
know.
Insider trading talks to trading in a security with information that is not publicly available.
Can I give you an example?
Yeah, well, I'll give you an example. We sold our company. We were negotiating privately. So the process was more intricate than that. We were negotiating to sell the company as a response to an approach. Someone approached our company with an offer. The board had an obligation to pursue that because at the end of the day, the board is there to maximize shareholder value. We contacted our investment bank. They encouraged us to do a price discovery process and validate whether that offer that was made unsolicited to us was appropriate or not by gauging the market. We put some information out there. We met with several individuals and we said, give us your offer. Some people came to visit. A guy in one of our rail yards called his uncle who lived on a farm in Chicago, outside Chicago, and said, hey, I saw these guys here and I had a meeting with my boss and he told me that they're selling the company. And his farmer, who had never traded more than buying 100 shares or whatever, went and bought 2 million call options on our stock and made like $5 million overnight when the thing got released to the public in a couple of days. Now, how he didn't get convicted, I was talking to the jury and you could tell these people are like, they had no idea, what I was talking about. But so this guy was acting on privileged information. So one thing is having market knowledge and intuition. So doing your market, hey, the county has published a master plan and their public works department has a 20-year plan on where roads are going to go, and there's a legitimate one where we want to expand Metro Rail in Dade County, and there's going to be a station at 72nd Avenue and next to the Merchandise Mart by the airport. That's still 20 years away. It may never get there. And you go, you know what? I'm going to buy something there and just squat on it. That's doing market research, processing, and acting. The other one is, dude, I found out something that other people don't know. And the guy that sold those contracts to this guy, the options contracts, did not have that information. Because if he had it, he would not have written those contracts.
Did that guy lose money? I mean, the guy that...
Well, I don't, listen, I don't know all the particulars. Well, he could have foregone making money. The issue is, and that's in the option realm, but think about the guy, the executive that knows the company's going to release bad earnings and sells the stock ahead of the earnings release. So, stock's worth 50 today, they're going to announce bad earnings. He sells his stock, all of a sudden the stock goes down to 30. He just saved $20 of losses, basically, you know? So, you know, the question is, the guy that bought the stock from him, would he have bought the stock at 50 if he knew it was going to go to 30 the next day? Probably not. Right?
That's a good example. That's a better example.
You know. So, but anyway, but so, you know, look, I walked into my boss was on several boards, and he's on the board of American Airlines at one point, and I forget what the issue was. I walk into his office one day, and he's talking to, you know, somebody, you know, one of the other board members, and I was looking at American stock at that point, just on my own, out of, you know,
AMR.
and well, yeah, then it's AAR now. So, but dude, I felt guilty because I had information that I shouldn't have heard, and I didn't buy the stock because I didn't think it was right. And I'm not trying to say I'm good or more moral, but what insider trading talks to is would the other person make the same deal with you that you're making if they had the same information? And that's what the law tries to provide in this country, is an equality, right? You know, a symmetry between all the participants to a financial transaction. We can talk about insider trading, we can talk about equities a little bit. Micro benefits. There are four sort of, and I'll talk to each one of them: volume, liquidity, risk, and maturity. Volume. I need to borrow $20,000. Can you loan them to me? Oh, I only have 5. Now I got to go, okay, now I need 15. You can loan me 7. Wow, now I need to borrow another 8. Can you loan me 8? You can only loan. So, volume is that all the savers can put their money in one place, and they've got enough volume in order to accommodate the user's need. Okay, the user doesn't have to go to all of these different savers. Liquidity, that's a critical one in a bank, right? From a variety of different perspectives, right? But let's talk to, yeah, I can loan you the money, but how do I get it back? Well, whenever, like in the next 10 years. Yeah, but what if I, you know, okay? So hopefully banks provide liquidity. Now, they can't provide liquidity to everybody at the same time, and we can talk about, when we talk about banks, it's called a run on the bank. When everybody's afraid the bank's going to go out of business, everybody wants to go collect. So the bank cannot pay everybody, right? A bank's balance sheet, right? The liabilities on a bank's balance sheet are what? Are deposits, right? And their assets are what? Like
the financial
loans, right? It's kind of like backwards, right? And so what happens is, you know, they might only have 5% cash because they need all these loans to generate interest to pay our deposits, right? And so if all the liabilities made a claim on the bank today, the bank would go bankrupt. They don't have the liquidity. But if we get big enough banks and they're regulated and people believe that they're firm, there's no reason for people to go run at the banks. The banks can give people the liquidity in order to put the money into the intermediary. Risk. We'd have to put all our eggs in one basket. Now you're not just loaning to me. You're giving the money to the bank who's going to loan to 1 million people that buy cars. And not all 1 million people are going to be deadbeats like me. Okay? Hopefully 97% of them or 98% of them are going to pay. Whereas when you make one individual loan, you're assuming significant risk, right? And maturity kind of talks to something similar to liquidity, right? Which is, you can loan me money for 3 years, you can loan me money for only 6 months, you can loan me money for 10 years, you can loan me money for a month, right? The bank groups all this together and says, okay, I can loan, how much you need? You need it for 5 years? I can give you a 5-year loan. I can sort of meld or blend this large pool of savers and be able to assume that sort of risk that an individual cannot. Okay? And then the last thing I want to talk about intermediation, the more sophisticated an economy, the more steps there are in an intermediation process, right? So there may be brokers or other intermediaries between these financial institutions and the users, you know. There may be brokers or other intermediaries between the financial institution and the user as well. Yeah. There might be brokers that are asset management firms that then place the money here. There might be brokers here that represent mortgage brokers, for example, or represent lenders that go to the intermediary. So the more sophisticated the economy, the more steps that there may be. We can go through this when we talk about, like, for instance, securitized debt, mortgage-backed securities, where you've got multiple intermediaries in a process. But ultimately, it talks to getting money from savers to users. Okay? Luis?
How the derivatives are, play in market intermediation?
Come again?
How derivatives play in market
Derivatives?
intermediation? Yeah.
Okay, I'll jump. I've got a slide on derivatives. So derivatives are financial instruments whose value is derived from something else. And there are basically 4 types of derivative instruments out there, okay? We have what are called forward contracts. That's really the basis of derivatives come from forward contracts. We've got futures, which is a standardization of that. We've got options, and we have swaps. Forward contracts really talk to the need people have a need to hedge risk. In order to hedge, you need people who are willing to speculate. Doesn't work. One doesn't work without the other. Okay? Basic example, without spending a lot of time on it today. We can do that another day. I'm a farmer. I grow wheat. What do I care about?
Tell us about wheat.
No, I don't care about that. I care about water, fertilizer, my tractor. That's what I care about. Okay? So I need to worry about that. And so what I want to do is I want to enter into a forward contract so I don't have to worry about anything other than delivering my wheat on a particular day. Right? I know the price, so now I can control my costs. Okay? I'm going to sell it for $1 a bushel. Now I know what I'm targeting. I'm wholesome bread. What do I need? Wheat. What do I need to worry about? Do I need to worry about water? And what do I want to worry about? I want to worry about how much it costs me, right? And getting steady supply. So I'm willing, this guy's going to hedge his downside, right? By agreeing to a contract at a price. Now I know what my bogey is. And the buyer is going to speculate that the price he's going to get now is at least as good as the price he's going to get in the future. Make sense?
Isn't that what the airlines did with fuel prices?
They do that with fuel, right? Absolutely. Now, so the basis of derivatives are forward contracts. Now, forward contracts are really what are called you know, over the market, over the board. They're sort of all individualized and unique to every situation. Futures is a formalization of that, in which contracts take standard sizes and standard maturities and standard values, and they essentially replace forwards. So that's not to say that there are no forward contracts, but most people hedge and speculate through the futures markets. Okay? Not going to spend any more time on that today.
Okay.
Options give people rights to buy
Or don't.
or to sell, for someone to sell. So a call typically is a right to buy, and a put is an ability to sell. Okay? Swaps are where people exchange their rights.
Una bermuda.
You typically see that. I'm sorry?
Una bermuda.
Una bermuda. I thought you said something else for a second. So swaps, you see them typically with currencies and with interest rates. So someone swaps their position. Typically you would swap a fixed interest rate position for a variable, or the other way around. And again, because there's a perceived benefit to it, right? One needs to have a benefit. So you have to have, there has to be what's the term that's used?
Mutual benefit.
No. Someone has to have a qualitative benefit over the other. Someone has to have an ability. So typically here, a large financial institution is going to have an ability to fix interest, and a borrower is not. But for a fee, the large financial institution is willing to swap their position. Again, because of their asset liability balance and because of their management of their balance sheet, to swap that fixed rate for a variable rate with you. Okay? You also see it with currencies. All right, so that's typically, and the notional value of these things are hundreds of trillions of dollars. They're significantly larger than the balance sheets that we see in financial institutions. We talked about earlier, so assets can be tangible or intangible. Intangible assets are, in the context of this class, financial instruments, and they ultimately relate to a claim that we have, and we talked about the two principal claims that we have, which are debt, which is typically a claim against the assets of a company, and we talked about equity or stock, which ultimately is a residual interest in the assets after all of the preferential claims have been paid. Okay. Again, we'll explore all these in greater detail. Typically, debt instruments trade. They can be private, right? Commercial banks, but they can trade in public markets as well. Those tend to be institutional in nature. Bonds tend to trade between institutions. That tends not to be an individual investment. That's changing a little bit. Stocks can be both individual and corporate. Securities can be offered by a myriad of different providers. So you can have private entities to governmental units that can be providing securities. This class is called capital markets, and capital markets really talk to a very simple concept, and that is you essentially have two types of financial markets. We have capital markets and we have money markets. Capital markets are markets that deal with the trading of securities whose maturity is greater than a year. Money markets are markets that deal with, exactly. So when we talk about money markets, we're talking about things like commercial paper, overnights. Again, not institutional in nature, although I'm sorry, not individual in nature, institutional primarily, but they do ultimately through a sub-intermediation process do become available to us. So we can invest in money market funds through intermediaries, okay? But ultimately, commercial paper, backstops, most of that's all institutional in nature. I'm going to cover one more topic briefly, and then we're gonna call it a day. And then we'll keep going. Next week, we'll continue with the balance of the first 5 chapters, but I need you to do the following reading, okay? Which deal with debt. Let's see what the syllabus is. It's in the syllabus, so. I sent an email with the scheduled dates. No, I pushed that back. Okay, the reading for the next classes are chapters 17 to 19 and 22 and 23. So what we're going to do is we'll finish the introduction and we're going to jump straight to debt, okay? We'll talk about interest rate and we'll talk about debt, okay? It's fascinating from a theoretical perspective, but it's fascinating, okay? So we've talked about financial assets. So the question is, what's a financial asset worth? You say something's worth whatever somebody's willing to pay for it, or what's somebody willing to pay for it. So it's a guy named John Burr Williams, 1938, wrote a book called The Theory of Investment Value, and he promulgated, Danilo walked out on the punchline of the whole class today, on his fundamental theory of valuation. And the fundamental theory of valuation, and I think I've said it before, is that the value of any financial instrument equals nothing more and nothing less but the net present value of its future cash flows. You've heard that before.
Yeah.
Okay? So the fundamental theory of valuation is that a financial asset is worth nothing more and nothing less than the net present value of its future cash flows. And if you take that one step further, the implication of that is that the validation to that is that in equilibrium, a willing buyer would only pay the net present value of the future cash flows, and a willing seller would only accept the net present value of the cash flows. Otherwise, we would not have a transaction. So market clearing prices necessarily validate that net present value of the cash flows. Now, the process is simple. Estimate, it's a 3-step process. Estimate your cash flow. Calculate your cost of capital. And then do the discount, do the calculation, discount it. 3-step process.
Calculate your
Your cost of capital. Now, that's it. That's what we do in real estate. And real estate is a financial asset. We estimate cash flows. We get a discount rate. We value it. That's it. When you loan money to somebody, don't you do that? Don't you figure out how much you're going to get back? Don't you figure out what your money costs you? You figure out what your return is? You haven't learned anything today. It seems like both things I've taught you today you do already. Why are you here? Are you going to leave? You're not going to leave, are you? But does it make sense? I mean, theoretical. Now, we'll talk more about this. So why do we have discrepancies, and why don't things clear market sometimes? Well, because people might have different estimates of cash flow. Sellers tend to be more optimistic than buyers, for example. Cost of capital. Different buyers have different cost of capital. Cost of capital, there's a couple of different ways. We'll spend some time another day on it. It's a couple of different methods that companies use. Some people use capital asset pricing model. We'll go through that in another class. You could use a Gordon dividend model. A lot of people don't use that, but I'll show you that that's an easy one to use. We just used to use an estimate. We figured out what other companies cost in similar sectors were to ours, because we figured we didn't have a lot of debt, so we couldn't figure out what true cost of debt was. Plus, we wanted to sort of benchmark, and so But there's a lot of different ways to work that out, okay? Daniel, you okay?
I'm sorry, I couldn't really tell what you wrote that below the gore, not the spam model.
The
Estimated percent?
estimate, yeah, they use estimates for your.
Yeah, I said we estimated. We used we kind of used an estimate based on what we thought other companies' cost of capital was.
Professor San Miguel, can we use real estate assets into those 4 types of derivatives?
Can we use real estate assets into those type of derivatives?
Yeah, can we, well,
Okay, let's rephrase the question.
REITs do it, right?
REITs do it. Do what?
Use.
Those 4 types, do they use derivatives?
Anybody could use a derivative. Forget REITs. A lot of real estate companies, for example, will enter into swap agreements to fix interest rates when banks or other institutions are giving them variable rates. So almost all real estate companies, developers, owners, will typically enter into real estate swaps. If you're an international real estate company, you might enter into currency derivatives. So you may enter into forward contracts to fix your exposure or to mitigate your exposure, okay? Especially if you're operating and borrowing money in foreign currencies. I would say typically options are purely, I shouldn't say they're purely, but options tend to be highly speculative in nature, okay? And so, as I'm thinking out loud and answering your question, I don't believe that you would see a wide use of options within the real estate realm, okay? I can't see why you would. There are several futures contracts that trade at the CME on related to real estate. I haven't done any work on this in a while. I don't, again, because I tend to think that's highly speculative. I don't know why real estate companies would hedge in any way, how you can hedge, but you can speculate, okay? The problem is, research shows that individual investors who speculate tend to lose their shirt. Institutional investors who hedge tend to break even or do a little bit better.
Some developers do the hedging, depending on if it's an up market or down market.
What would you hedge?
Like line, the cost of the line. You would contract and
Well, you might,
have a fixed price.
okay, so you've just brought something up. You might enter into an option agreement to buy land. So you may have an option on land, but that's not a tradable, that's an over-the-counter, that's an OTC, okay? That's an over-the-counter transaction. But that's not typically puts and calls, you know, that you trade on stocks. And the futures that exist that I'm aware of related to real estate, there's a series of indices that track residential real estate prices in certain markets in this country. And those are, what's the guy's name's a teacher at Yale, Schiller. So it's whatever Schiller index, and so people speculate on residential real estate values in certain markets in this country, and there's a series of contracts that track indices, broad indices, NAREIT indices. Okay. I'm not sure. Again, I think I can't see a home builder hedging by, you know, selling futures or buying futures on the Schiller index. I don't see it. Now, I'm not telling you that they don't, but I don't see people doing that.
So swaps and forward are the most used ones in real estate, according to your knowledge?
Yeah, I mean, listen, do we enter into forward contracts in real estate all the time? would I view forward contracts in real estate, purely in the same sense as I would with other commodities? No. But do they have the same sort of features and benefits to the buyer and the seller? Absolutely. So, yes, we can enter into forward leasing or sale transactions, right? Or purchase transactions, depending on which side you're on. And we would definitely, at least in this country, see a tremendous number of swaps, interest rate swaps, typically from variable to fixed rates. Good question. There being any other questions from the peanut gallery? No? Then it's time to, listen, it's 12 o'clock. I think some of you have a class at 1.
12:30.
12:30.
Oh, it's not 1 anymore?
Nope.
Wow. What time do you leave?
4:30.
Oh, okay, you don't leave at 5. Wow, you made it sound like. Okay, so I'm gonna let you go get a good lunch. So when Dr. Wurtzel comes in, you guys are all smiles. Okay? And Natasha, I'll get back to you.
Yeah, I do. From
So-
Daniel, hold on, last question. Daniel, you need to sign up for the Wall Street Journal assessment site. Check your emails.
Assessment side?
Check your emails.
Well,
Let me know.
oh, for news? Oh, well, I already have that.
But
No,
for the
no, no,
students.
not for news, for the quiz, it's due on Monday.
It's a student.
Okay.
Check your emails. And then, hey, and the last thing, those of you who came late, if you go to the student reception at YOLO on Wednesday with the alumni
You get a free what?
and the advisory board, in addition to free appetizers and liquor, you get 5 points in this class. Woo! 5. That's how important I think it is. I never give extra
And
points.
it's your network, really good, you get.
So that means that if you have a name, a B, you get a name?
You get 5 points. You should have gotten emails on this stuff.
The test, the quiz, the final grade. 5 points in the final grade?
5 points.
In the final grade?
No, 5 points.
I know, 5 points in what?
So like if you got a 90, you could get a 95.
In the final grade.
On the final grade, yeah.
Ah, final grade, there we go. You gotta give all the information out. Otherwise you decide to trade.
It's like a real 5 points.
All we do is just email us accordingly, correct?
Yeah, you just have to email them that you're going and then go.